Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, traders, authors, educators, money managers, learn how they have evolved as investors over their careers, understand some of those formative events earlier in their career, how their investment process has evolved, what tools and techniques they're using to understand the markets during the volatile times of 2025. Really fun conversation today with Mike Webster. Mike's the senior market strategist at IBD. I met Webby probably a couple of years ago when I did IBD Live for the first time, and Mike was one of the panelists. And I found we just connected immediately. Anytime I was asked a question, I would sort of make a point. I could see Mike kind of shaking his head. Anytime Mike was weighing in on a chart, I would be shaking my head going, yeah, that's pretty much how I would do it. So I think we're kindred spirits as market analysts. But it was really fun to learn some really great stories about Mike's career in the financial industry. After doing a couple different things, Mike actually approached Bill O'Neill, the legendary William O'Neill, author of How to Make Money in Stocks, creator of Investors Business Daily, and pitched him on giving him a job, and it worked. And Mike eventually became a portfolio manager for William O'Neill and Company's institutional clients. Now works with IBD, working more with individual investors and financial advisors through their great products. We talked about his early days at IBD, discussions with Bill O'Neill, what he learned in some of those formative years at the firm, and how that shaped him into the investor he is today. We talked about a lot of the quantitative methodologies that are employed by IBD, and you will learn that Mike actually created pretty much all of those, from the IBD stock Checkup, which I remember being released in the early 2000s, to the IBD Composite score, all the different ways of percentile ranking stocks based on different fundamental and technical metrics. Mike, in some ways, created most of those, and if not, really grew those into a meaningful part of the platform. And it was a lot of fun just learning some of those origin stories, because those are tools that I've used for most of my career. We talked about the relationship between technical and fundamental analysis. Bill O'Neill is famous for using charts as a way of understanding the company and thinking about the relationship between strong price action, a strong stock, and strong fundamentals, a strong company, and thinking about a company's ability to grow earnings, but also a stock's relative strength, and why combining those can lead you to some of the best winning stocks over the years. Talked a little bit about risk management, which I really appreciated. Bill O'Neill's approach is famous for having very simple risk management rules, and I love talking with Mike, who's a little more of a swing trader, about how he thinks about risk management, particularly during an uncomfortably volatile year like 2025. Mike spends a lot of his time these days working on the Swing Trader product for IBD. So he talked about how he identifies some of the top ideas and stocks that he shares with subscribers every week. A lot of fun in this conversation. This was a great one, talking about investor psychology, really profiling one of the legendary, market educators, Bill O'Neill, and a real pleasure to talk to someone like Mike, who is an incredibly accomplished investor in his own right, but really had an opportunity to work with one of the greats, and it was great to get some of those stories out for all of you to learn as well. So please enjoy this conversation with Mike Webster, Senior Market Strategist at IBD. So super excited to be sitting down today with Mike Webster. Mike, I met you, through IBD. You guys have invited me on to IBD Live a number of times, and I found the main reason why I wanted to invite you is I feel like when I come on that show, you and I tend to nod around similar times, right? We hear something, we see something, and we have this sort of, this moment where I feel like we're both in agreement about what's going on. So I'm super excited to have you on the show and pick your brain a bit about how you're approaching these markets. So welcome to the show.
Yeah, well, man, thanks for having me. And I always look forward to whenever you're on IBD Live, and because for that same reason. I think we just look at charts the same. We might, every trader has different tactics of how they, do things, how they get in, how they get out of the market. But if someone's been, trading for a long time, looking at millions of charts, you get a feel for what's normal and natural. And that's how I think everything gets boiled down to. And if you know, and then you can see something, go, wow, that's odd. And I could see that with you. And I think we just basically look at it through the same set of eyes, man.
I think you're right. I think you're right. Now we've come to this realization through different career paths for sure, and I'd love to learn more about and share a bit of the story about how you have come to be the investor that you are today. You've been with IBD for how long now?
So I started at William O'Neill and Company, and that
Yeah.
was their sister company
Hmm.
in February 3rd of '97, and
Right.
I was there until 2020. And in 2019, I moved over to IBD. And then in 2020, I left to come out to Austin to run a family office, like a hedge fund that we didn't take outside money. And I was the head PM there. And that was a lot of fun. But I frankly missed teaching, and I missed IBD and Bill O'Neill, who was my mentor. And, man, like everything as far as when it comes to the market, I had a dream of working for him and the goal of working for him. I had quit, this is going back before '97. I quit
Yeah.
another job. I was working at T. Rowe Price, and
Hmm.
I took a pay cut. I was on the customer service side of things over there, and I read his book, and I'm like, oh my God, I have to work for this guy. Like, there is no plan B at all. And I mean, zero. I said, I'm working for him, no one above or underneath. And I wanted to be a PM with him, for him. And that was a long haul. I became a PM at the end of 1999, which was really fast, but at the time it seemed like forever, because you're
Yeah.
young and time is different. But in '99, I impressed him enough. I don't like to talk about it, but I was up like 1,640% in my personal account without options. I did use margin. Margin's a big
Yeah.
part of what we do, and frankly, I wasn't even trying to make money. I was just trying to show him that I knew how to pick stocks for
Mm.
our institutional buy list that we'd sell to Fidelities of the world and the T Rows of the world. And so I would just try to pick stocks before he picked them. And then if he put them on, then for compliance reasons, I would have to sell them. And that kind of got me into swing trading by accident, because I'd buy something right at the exact pivot, because I was really trying to prove something, because it was hard to become, like, very hard to become a PM there.
Yeah.
And so I'd buy it exactly right. And then, in front of where he would buy it. And then if he put it on 2 or 3 or 4% later, I'd have to sell it. Or if it went up and he never put it on, I would just sell it into strength to try to buy the next one. And so it was a weird way of, like, you know, stumbling into swing trading, which at the time I didn't even know was a thing, because he's a
Yeah.
position trader, and I do
Sure.
that as well. Like probably what you do is, more orthodox position trading, where you're trying to hold things for weeks to months versus days to weeks. And so I blend both of those. But anyways, to make a long story short, I was, when I came out here to Austin, where I still am, I just missed all the people. But really, when Bill passed away in 23, on May 28th, it would just, I just had this calling, like I had to come back, and I know what he would have wanted for the firm, and I wanted to contribute that.
Mm.
It wasn't the smartest thing to do, to go from managing money to going back to the paper, but it's where I want to be right now. And I love the people, and I love giving back, because there's more to the world than, just trying to make the most amount of money. And
Yeah.
it's just it's fun being part of this, trying to, carry the torch, or however you put it. So
Yeah. I'm a big fan of doing something you're passionate about that gives you fulfillment and
yeah.
trusting that the numbers will all work out down the road. So I commend your decision. Some would argue you've made the right decision in so many
Some
ways.
would argue that it wasn't too smart, but it's okay. It's okay, man.
That's fair. That's fair.
Yeah.
That's fair. So tell me this then. So really your experience then stepping into a money management role was essentially toward the end of the tech bubble. Talk to me about the early years and some of the challenges you felt transitioning from the, kind of go-go years of the late 90s to an incredibly challenging period as a money manager, the early 2000s. What sort of formative lessons learned
Oh,
rocked you in those early days?
man, that's a good question. Like, so much changed, right? Because as we both know, the like 1924 to 1929 was pretty much like 1995 to 2000,
Sure.
and so you have those similarities, and then you have that like 1929 to 1932 was just like 2000 to October of '02.
Yeah.
And so that was hard. And I had, during that bear market, luckily, I was having fun because I impressed Bill enough, for the short period of time where before the March top in 2000,
Mm.
to where he asked me to come down to his office and spend a few years with him there. And then we got to work on projects together. And then I started picking names for that list with him. And we talked daily and managed that institutional list together, as well as me managing his money. One
Mm.
of like 10 PMs. He'd always keep about 10 PMs. But during that time, that was rough, man, because we were still in that mindset of when you got a follow through day, which is a key part of the system that he developed, that we would plunge in. I know he always
Mm.
says you only have to buy one or two stocks or whatever, but we're racehorses, man. And so we would plunge in, and then you'd get nicked, and then you get
Mm.
nicked, and you get nicked, and so it was like 2000, 2002 was a lot of paper cuts that added up to losing an arm or two, and so luck, luckily in March of '03, when the market turned, so we came down, we hit the bottom in October of '02, and then moved up, and then came back down, and we had three waves down in March of '03.
Yeah.
And during those three waves down, I had been knee deep into studying the 1929 to 1932 time frame because I was just
Mm.
fascinated. I was obsessed. And when I put the charts together, and this is before anyone else was talking about it. I didn't hear anyone talking about it. And I was overlaying them, and I'm like, this is identical. Like, this is
Yeah.
not similar. This is the exact same thing. And I took these charts that I marked up with the precedent, and the precedent analysis is a big part of what we do and what Bill did. And I showed it to every PM, and every PM was like laughing at me because this mindset of this 2 year long bear market was just like
Yeah.
every time we thought things would change, they hadn't changed, and we get
Yep.
our head handed. So no one wanted to, veteran, really smart, great traders, like they didn't want to hear me super bullish. And I had said at the time, I go, if I'm not right on this precedent, I need to find another career. It's stupid, man. You don't ever say that.
Uh-oh.
It's like,
Don't say that out loud, Mike.
yeah, but I did, because I was that, I mean, I was deep in, like, I get obsessed with things. I was deep into it.
Yeah.
And then finally, even though one by one, all the other nine PMs just like basically laughed at me, I then called up Bill and I'm like, hey, I've been studying this thing. I think I've got this down. And this is back in the fax days. So he's like, fax me the stuff. I
Yeah.
still have them around in the garage.
Nice.
And I faxed it to him, and he called me right back. He's like, he saw it, and that's why, like, I
Mm.
like you, because I can tell when you see something on a chart, and like we're seeing it the same way. Bill
Yeah.
saw it, and then we just went back and forth on it, and then that got him all bulled up, and that was the turn in March of '03, and
Mm.
we just gunned it heavy, and both of us were just thinking this was going to be like 1932 to 1935, which is what it
Right.
it, it ended up being, because
Pretty
I just
good. Yeah.
believe in these cycles that repeat because of the human nature, and they're not always exactly the same, but that's what precedent analysis is based on. But
Yeah.
that was, I learned a lot from that. And one of the things is never be that cocky about a precedent because precedents break all the time. But I was right about it, but uh, I'll never do that again. I'll just say this is what I think is going to happen. But yeah, that was pretty ballsy, frankly.
Hey, it
It was
worked.
fun.
Okay, then
Yeah,
it's a victory. All right,
yeah,
so you've mentioned working with William O'Neill, obviously a legend, and I think someone who did more to educate investors than anyone I can come up with.
yep,
And you'd mentioned his book, How to Make Money in Stocks. That's one of the three books I recommend to any new investor. I say read this first, and then we'll talk. Years ago, my William O'Neill rep, when I was at Fidelity, dropped off these awesome mouse pads, which you probably can't see, but it's the eBay
And
from
Brunswick.
the early 2000s, Brunswick from 1961,
Yeah.
and these are replications of Bill's charts, where you can kind of see the price in the background, but it's a lot of his handwritten notes all around the chart. Can you talk a little bit about the relationship between analyzing the charts, analyzing the trends, and all the other stuff that makes a good company, and how O'Neill and how you and your process kind of combine those in a meaningful way?
Sure. So if Bill were here, he would say that it's 80% fundamentals, which on
Mm,
that chart, those charts that you have, the mouse pads that you have,
yeah,
lots of those things that he would be circling or marking were are related to the fundamentals.
sure.
What's the earnings, return on equity, sales growth, all those things that are very, very important. But he also wanted the chart. So even though he would say it's 80% fundamentals, I would say it's almost 100% fundamentals and 100% technicals, because he'd want both of them to
Yeah.
be there. If the technicals weren't perfect, he wouldn't want to play. If the fundamentals weren't perfect, he wouldn't want to play. So you can't have, I will swing trade with stuff that the fundamentals are just junk, because it's just a quick little trade, but I'm not going to position trade with that. So there's two different lenses
Mm,
that you have. And he was a position trader. And so it was very fundamentally based. And frankly, we did a lot of work with institutional we would look at the institutional holdings, the sponsorship, and see like what were the big funds doing? Were they adding, decreasing? And there were funds that he didn't like. If they were in there and increasing, he wouldn't want to play. Like
mm,
when we would look at a chart together, and that's what would how we managed the list together. And the PMs could only trade what was on the list,
okay.
including Bill, is because we wanted to give our names out to the clients first, our institutional clients, and then we'd have like 24 to 48 hours before we could trade it. So it
Hmm.
was in our best interest to get the best names on that list early so we could all build positions in it. The
Right.
first thing that he would do when he would look at a chart would be look at the monthly, to see the character of the stock over time. Was this just a thing that goes all over the place, or was it a steady eddy? Is it something fast that's coming up? As you know, every stock has a character, and so the monthly really shows that character. Then, before we do anything else, we look at the sponsorship, like in great
Mm,
detail, and see if the sponsorship wasn't good, we just move on to the next stock. It was that was a big that's a part that I think most people don't um, look at. And on IBD Live that we do every morning, I'm on Monday, Wednesday, and Friday on that program. That we just don't have the time to get into that because it takes a while to get
yeah.
into the sponsorship. But that was his way of looking at fundamentals, because he thought we're at the organization, we weren't going to go out and meet with the CEOs, or we weren't going to meet with the CFOs or anything else. We were relying on the Fidelities of the world in similar to go and do that work, and then we were just kind of trying to ride their coattails in a
Mm,
legal way with
yep.
and so that's how he looked at fundamentals, really, was through sponsorship. But then obviously the earnings, the sales, and all the other things had to be there. But he was very unique, and he would look at everything that he felt was important. And if he didn't feel it was important, he just did not care. Like he didn't care about valuations
Yeah.
at all,
Yeah.
like
Yeah.
at all. And he would just kind of laugh if people said, let's say there's three stocks in a group to pick from. He's going to gravitate towards the best looking one, regardless of the valuation. And typically that would have the highest valuation, where so many people wouldn't want that, right? Because they're
Right.
ingrained in this thing of, oh, a lower PE is better, or a lower book to value, or a lower this or that. And that's
Yeah.
fine. That's a different style. But what he learned was from the best growth stocks over the decades and over the century, really what really mattered. And that was in our model book studies, and what everything was based off of is what really worked, not what sounded good. And there's a
Yeah.
big difference. A lot of people on the street, is what sounds good, like what sounds good on CNBC or whatever. That's fine, but what really works in the market is it can be different, and you know that.
Yeah. Oh, for sure, for
Yeah.
sure. I mean, I learned so much from, and again, I only met Bill O'Neill a couple times virtually because a number of the portfolio managers at Fidelity were huge consumers of his work. A number of them would speak to him regularly, and he was super kind to come on and do some
He
webcasts with us,
loves
which,
Fidelity, man.
oh man,
He
it
really,
was awesome. And
yeah.
and those were just fantastic. I feel like I was just so happy to be in the room listening to this conversation happen at the time when I heard it happening. Tell me about risk management. What did you learn about risk management from working with Bill? And how do you apply risk management in your process today? What does that mean to you in 2025?
Well, I do things differently than how he managed risk.
Yeah,
So he was great at managing risk in the very unique way. Like if you don't know Bill O'Neill's way of that he made his fortune is he would pile into one stock full margin. Like that's
yeah,
what, like that's one stock,
right.
on full margin very often, not very often, but over decades,
Yeah,
often enough. But he wouldn't do it right away. And that, he
mm,
would slowly do it over time and over weeks and over
yeah,
months and add and pyramid into it as his stock is working. He would never average down. He would always average up. And so he was watching it like a hawk. And what he would look at is the difference between his cost basis and where the stock was at the time.
okay,
And he would refer to it as a cushion. So let's say his cost basis was $50 and the stock was $80. So and this is pre-Reg FD, so you didn't have the gap downs like you have now.
yeah,
He would say, okay, his cushion is $30, and he would find a level that was comfortable, that he wanted at least a $20 cushion, let's say. Then if the stock started to curl and come down, he would be selling off his high cost basis stock first. So he would have the CFO do it, not a last in, first out necessarily, but a highest cost first would go out. And that's how mentally he would manage his risk, because he was
mm,
saying he's selling off his high cost basis stock. He still has his profit in this other thing. And that's how he did it. And for years, I tried to be Bill. And everyone I know tried to be Bill in one way or
yeah,
another. And
yeah,
everyone failed, including myself. I just not Bill, and no one is like, and
yeah,
that's and no one's David either,
yeah,
because everyone is unique,
mm,
and so your risk and how how you got here, everyone is unique. And that is what worked for him, because back in the early 60s, he did that with Chrysler right after the Cuban Missile Crisis. He loaded up
wow,
into Chrysler, killed it there, then took that money and parlayed it into Syntex, which was the birth control pill, and that
wow,
had a high tide flag, and he just nailed that one like perfectly. Like it was picture perfect. So then all of a sudden he had all this money, and then he started the firm with it. But so he had made this money from pyramiding going all in. And so those
mm,
charts that you have there, not Brunswick, but the eBay one,
yeah,
he did that. He went all in, and he started that in '02, started buying eBay, and that was the one that worked. And then he built that position even larger in the '03 time frame. But that was his comfort level, as going super heavy. Now I will go super heavy, but I do it wrong. Frankly, I press the gas too hard too quickly, and that's a thing
mm,
that I fight. And you always have to be aware of your strengths, but also your weaknesses. And sometimes they're the same thing. Like what my strength is the ability to be aggressive, but my weakness is also my ability to be aggressive. So you want to adjust. And to get at your question, how I do it now is I plot my equity curve, and I run Swing Trader at IBD with Justin, and he creates this equity curve for us, and I will base things off of from a swing trading lens, shorter term. Are we above our 10-day equity curve? Just your account balance. Are you above it or not? Are you above your 21-day? And if we are, we trade a certain way. And if we aren't, we trade a different way, more conservatively. If you're
mm,
position trading, then I would do that with a 21, a 50, and a 200 day on your account, and use that and look at it like it's a stock. As you're doing well, as it's doing well and trending, you're feeding it. You're putting the gas pedal down. As you start curling and you start coming through your moving averages, that's when you have to start backing away. At least that's how I look
Right.
at it. You know, that
Right.
everyone has their way of doing it, and I try to keep it as simple as possible. And I think if you're trying to make money, right? So what do you want to look at is that your your account, because and
Yeah.
then base off of that, not off of, oh, I think this group is hot and I think that group is bad and I'm going to adjust it accordingly. Sure, you're doing that too, but really at the center of it is, how's your account doing? If you're doing poorly, adjust, be smaller, something, Marty Schwartz, a pit bull, from the
Hmm.
Market Wizards, has
Yeah.
in his book. When he was doing poorly, he would get really, really tiny. And that's something that
Yeah.
I've always tried to do, is like when I'm doing poorly, there are times where I couldn't, you could give me like 10 stocks and 9 of them are going to be great and one of them is going to be bad, and I'm going to pick that bad one. There are times like that, right? It doesn't matter. You just can't do wrong. And then sometimes, it works both ways, where just everything you do is right. And so when that's happening, you need to take advantage of it because you're hot and you're in the zone, and you want to be aggressive and push it during that time. But
Mm.
you need to really recognize it once that starts going away and just back away. That's my
Know
take.
when you need to back away. That
Yeah.
great life lesson right there.
Yeah.
What? So you mentioned Swing Trader, which has been, I remember when that was launched, and it was I feel like a really interesting addition to sort of the suite of tools that O'Neill was providing to the world. When you are and you and Justin Nielsen, right, are doing
Mhm.
swing trading,
Yeah.
Swing Trader. What do you do, or how do you identify the names? What's sort of that ideal setup that would compel you to want to put it in and spread the word about this particular opportunity? What does that ideal setup look like to you?
So I'm screening all day long. So I pick the stocks of what to put. He does all the hard work of like sending the stuff out, marking up the charts, and all the like the
Yeah,
real work. And I'm doing you know, the easy stuff relative to that, of
yeah,
because there's so many moving parts behind the scenes that he handles, and he's a saint. He's like, there's no
yeah.
one better. That I've been working with him since 1998, and he's the best around.
Justin's awesome. Yeah.
He's the saint. That's why I call him the saint. But so what I do is I screen all day long, all day
Okay.
long. It's just how I've always operated. So then I get a feel for what's working. I'll screen for things that there's no way I'll ever trade them, but I want
Hmm.
to look and see how are they acting, and I have a very set thing for swing traders. So it has to be above $10, has to be above 75 million dollar volume, has to be above its 50, has to be above its 200-day. Those are just very basics. But then risk reward, I'm looking at it and saying, okay, how much risk can we take as how our portfolio is doing? So everything is, I treat that not as picking stocks. I treat it like a portfolio, just like it was an account. Because you know how it is. If you're just picking stocks, that's one thing. There's nothing wrong with that.
Yeah.
I'm fine with that. But that's what we did with our institutional side. We just put it on, say this is on. But with this, it's like, what size is it of the account? How much do we have in that
Sure.
sector? And really, one thing I'm leaning on heavily these days is the ATR, the average true range, as a measurement of risk for the account. And so it's the stock specific. So I don't want anything higher than really, an 8 ATR, meaning 8% that it travels every day. Most of the ones that we have on right now are, around 3%, give or take. There's
Mm.
some a little bit higher, but 8 is on the extreme level, because if we like to keep our stop loss at 3 or 4%, if
Okay.
you put an 8 ATR on there, the likelihood of getting chopped up is very high. But
Yep.
we will go out that far, but I like keeping it lower ATR just because you're less likely to get clipped. But I keep my stops very tight, so we get, put it on, take it off, put it on, take it off, and then you put it on, and then it works. And
Yeah.
that's not a comfort zone for a lot of people, but it's my
Yep.
comfort zone. So it's, you got to find what works for you. Some people would rather have a 7 or 8% stop loss than a 2 or 3% stop loss, and then give it more room. And if you're wired that way, do it that way. I'm wired more like, if you buy it, just kind of like the Livermore, if you buy it, it should go up right away.
Yeah. Yeah.
And that's how I've always, my best trades have always been where I buy it right and I'm never down on it. And all the
Hmm.
other ones that you buy it, you think it's going to be great, and then you're down 2 or 3%, and you're like, oh, I'm going to give it a little more room. Then it's 5 or 6%. Oh shoot, now I really have to sell it.
Yeah.
So
Yeah.
it's the way it goes.
Justin Mamus, legendary technical analyst, said, "So I'm brutalizing his quote, but it was something like, if you buy a stock and it doesn't do what you think it should, sell it." And
Mhm.
that is a great, I mean, just a great way of thinking. It's like you have this idea in your head. This is how you structure the trade. It works beautifully. Everyone's happy. If it just doesn't do what you're thinking, the opportunities, maybe not there. And I love your comment, Mike, about focusing on average true range. I vividly remember in my Fidelity days having lunch with a hedge fund manager in town, and we were talking about risk management, talking about stops, and he told me that he had a volatility based exit strategy, and I was like, "What's that?" And he laid it out for me. I was like, "I don't know why I've not done that. Why would I ever not do like that? Just makes a ton of." And you're
Right.
adapting for the natural movements of the market. And it's just a, I encourage people to eventually get there. Start with something simple you're going to stick with, but eventually that's the place you want to be. I would love for you to share, because I'm, if I remember right, I believe you are part of the origin of some of the quantitative tools in IBD, things like the composite score. Is that true?
Yeah, most of them.
Yeah,
So I compare, I created most of this stuff. So created the composite rating, the growth
yeah.
250, pattern rec, the 3 month RS. I invented the IPO base. I mean, I just like inventing stuff. It's fun. It's fun.
Talk to me. So, and I thank you in front of everyone, because I mean, that was one of my first introductions to more, percentile rankings, this idea
Yeah,
of just focusing on what's working relative to a bunch of other things. Can you talk a little bit about the composite rating? Was
sure.
that, I mean, I'm assuming at some point you had to pitch Bill O'Neill on, I think this is something we have to do. Was that an easy sell, or was that a challenge to sort of pitch this more quantitative method as part of the methodology?
Well, right before I became a PM, that was my project that I had was similar.
Mm,
It was called the
okay.
stock doc. They still have a version of it, but we use the composite rating versus the ratings that I had created. I had
Yeah,
created a
some of the cartoon
yeah,
doctor
the
that had the little
cartoon. That
rating.
that
I
was
love it.
that was
Love
my
it.
first baby was I didn't create the cartoon, but everything else around it. And I had, like a group rating, I created a new group rating, a technical rating, a fundamental rating, some other stuff. And then I combined them up into this one overall rating for the stock. And then I did it within the group. I got down into the weeds with it, but the end result was simple for people to use. But that was on the web. And Bill was old
Mm,
school. He didn't use the web. And he called me up one day, left a message on my voicemail, and he's like, Mike, people are canceling the paper because it's too confusing. We need to come up with something simple. Call me
yeah,
back. And it was on a weekend, and I'm like, oh shoot, man, because I would call him every Sunday night. We'd spend a couple hours together, but I'm like, oh, this was on a Saturday. I'm like, oh man, so I got to do the Saturday things. So I call him up, and I try to explain to him. I'm like, Bill, remember I've got this stock doc thing that does this, and he's like, no, 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 we need it in the paper. I'm like, well, we could put it in the paper, and there was a disconnect. He's like, no, we need something simple, and that's all he
yeah,
told me. He's like, we need something simple. And I'm like, okay, I already spent like a year on this other thing that was very complicated. And I'm like,
yeah,
okay, what can I do that's the polar opposite of that approach to get at the same thing? And I said, okay, what he's really after is people were saying, well, you've got this EPS rating, accumulation distribution rating, industry group rating. Which one is more important? What if this one's an A and this one's a B and this one's a
sure.
99 and this one's a 3? What do you do? So I sat for a long time, and months or however long it took me, and developed. I said, okay, well, we've got the RS, which is how it does relative to the rest of the database over a 12-month period. We double weight the most recent quarter. So okay, that is the most important thing, by the way. I did a big study, and RS rating is the most important.
Yeah, yeah,
And then EPS rating. So I double weighted those. So those, because those were the kind of the core things that Bill had come up with decades ago. decades before I started at the firm.
Yeah.
Then a newer rating was the SMR, which is sales margin return on equity. Put that one in there. Put the accumulation distribution in, which is just it's not a relative rating, but it's price and volume
Hmm.
based. Industry group, of course, that's very important. And then I put this percent off high in there, and then combined them all, and then turned those raw values into each one of them into a 1 to 99, then put them together and then did that in a 1 to 99. It's very simple. Like, it's the
Yeah.
most simple thing. And it ended up being his favorite indicator, favorite by far. And then one
Right.
day he told me, he's like, Mike, don't you ever recommend a stock to me that has a composite rating of less than 88. He'd go back and forth between 87 and 88. And I was not allowed to give him one. And it was this thing that I created for him. And it cracked me up, man. It was, but it works really well.
Yeah.
There are exceptions, just like, there are to everything else. Otherwise, I would only screen for stocks with a composite over 88. But there's nuances to everything, as you know. But
Yeah.
yeah, that one is near and dear to my heart because it was his favorite. I'm in the process right now of updating all of the ratings
Hmm.
at IBD, and I'll be updating the composite rating as well. I'm not sure when we're going to release those, but I'm very excited about it because there's some things that I wanted to do differently.
Yeah.
And I created the Growth 250 as well, which is 44 screens that are combined into that one list.
Yep.
Because they had said, again, I was asked, hey, everyone's confused. What do you use? The weekend review, the IBD 50, which at one point was IBD 100, or do you use this or that, the big cap 20? And so I wanted one list that would capture everything. So I just sat down with a model book and I opened it up to page one and I said, okay, I got to write a screen that is going to get this stock in. And then when I did that, I went to the next one and I just spent, I don't know, a year or something of just doing that until I got the screens right that would have captured them at the beginning of their move. And
Mm.
I'm going to be doing some tweaks on that too. So yeah, it's just fun. You know how it is. I mean, it's just fun doing this stuff, right?
Right.
Yeah.
Now, I listen on behalf of me and all the other investors that have at one point found a really cool idea from the composite score. I have to thank you
Oh,
for
sure.
your innovation and your work in optimizing that. That was a game changer for me for sure. We've managed to get through almost an entire interview, Mike, without talking about the current market environment, which I'm kind
Yeah.
of okay with because it's been pretty crazy.
Yeah.
However, I'll ask you just one question. 2025 has obviously been a pretty climactically challenging year for many investors. What have you learned as an investor from 2025 so far? What do you think, looking back, will be your biggest takeaway from this? What hopefully ends up being a good learning experience for all of us?
Yeah, that we have kind of this new type of bear market that,
Mm.
over time, if you study, history and you go back into like 1900 and how that to like 1915, 19, like how that traded. And then from that time to 1924 and how that traded. And then, the 40s. And if you look at everything, or like 66 to 1982, like that
Mhm.
range bound thing, like everything has kind of this unique thing. And what's kind of happened prior to, or like the COVID bear market and then this one were very similar, where we didn't have another retest. Like in
Mm.
1998, you remember that brutal double bottom, the 33% decline that we
Yeah.
had. We had one brutal move down, then we went up to the 200-day and then came crashing back down, took out the lows, and then turned and had
Yeah.
that massive run. That was normal and natural. But now I think things have just changed a bit. In things do change over time. Like because the Reg FD was a major change. I do think
Yeah.
the algos and options changing as much as they are, ETFs, high frequency trading, free commissions, tight spreads, all these things combine into where things do morph in their subtle changes. And I think with a bear market, we have to be more open to the fact that you can have these I call it a crash that we had this year.
Yeah.
a
Yeah.
crash, and we were able to get out of it with Swing Trader. I'm very proud of that. That we were out of it. I always wanted, Bill was out in 1987 and in cash, and I
Yeah.
always wanted to be, do that, and we did that when I was running Swing Trader back during the COVID crash. We went to cash early in February as things started rolling.
Yeah.
Early on. And then the same thing here. We went to cash. We went in like, there was a follow through day that we went in and then backed away. But I was really thinking we were going to come back down again, just like we did. I was thinking in COVID that we were going to come down. I thought it was going to be like 1998, and it
Yeah.
wasn't. So having that open mind that this thing that's never really happened before can happen. And that's very important because we lean heavily on precedents.
Yeah.
Um, but sometimes things do change, and this bear market was different, just like COVID was different than anything in history, really. And so, to answer your question, to be open to things being different, because we know you're never supposed to say it's different this time. Like that's a famous last word, right? But it is the market is shifting that way, and I'm not sure why. Do you know why?
That's the question, right? I feel like many years from now, people will look back and be able to identify why, but living through it, it's very hard to get a read on it. I would argue, right?
Yeah. And so
Yeah.
then the other thing is just trust your instruments. Like, there was
Yeah.
a follow through day. We had the power trend, or the power trend was something that I invented with Justin and Charles Harris as part of the
Yeah.
IBD market school rules. And that's a very simple thing, but it's very powerful. It's just four things. The easy ones is you started on an up day, the 50-day has to be in an uptrend, but the two things that are difficult are your low has to be above your 21-day exponential for at least 10 consecutive days, and your 21-day has to be above your 50 for at least 5 consecutive days. When all those happen, that's what we call a power trend. And we
Right.
studied that, created it, studied it, and found that your best times in the market are when these happen. Now, they don't always lead to these big bull markets, but you don't have a big bull market without it.
Yeah.
And that's what we're in. We've been in it. Now, it doesn't end until that 21-day crosses back through your 50. So
Okay.
by the time that happens, there's a lot of damage in the market. So you don't want to
Sure.
wait until that to back away. So what I use is as long as you're above the 21-day, then your gas is still down. If you
Yep.
close below that, then that's when you have to start backing away, and then be flexible to gas it if it comes back above the 21-day, because they test the 21-day all the time in a move. But yeah, it's been a fascinating year so far, and you just gotta, I think, shut off the news, shut off the anything that you hear from anyone else, and just look at the chart and just be as objective as possible. And that's what I learned from Bill. I mean, that's what he did. He didn't look at a bunch of indicators. Not that there's anything wrong with that, but our
Yeah.
style is just figuring that all the indicators are built in, that everyone knows it and they're acting on it, right? If you have
Yeah.
some magic indicator that is telling you, to be bullish, well, then the market should be moving up, and you should be able to see that in the indices and in the price action. And that's what I learned from him, and that's what I, do as well, and just keep it as simple as possible.
Yeah.
Yeah, that's just my style.
I love it, Mike. That one a quote we had hanging up in the chart room at Fidelity: "Forget the news, remember the chart." And I
Yeah.
feel like that quote has come to mind a lot of times here in 2025 as good words to live by. Mike, this has been such a pleasure. I really appreciate you coming on the show. You have a podcast as well, which you've recently launched. Congrats on that. Tell
Thank
us
you.
about that. What's your goal with the show there?
So I have a podcast, and I'm looking forward to having a guy named David come on and be one
Can't
of my
wait.
guests. So
Can't
I'm
wait.
I'm
Have to get to
hoping
it.
that, yeah. So um, really, what I wanted to do, one of the reasons why I left to come back was it, as my role here or out in Austin at the family office, is
Hmm.
I couldn't talk to people. I couldn't talk to people about the market. It was just one of the rules that we had, and I was fine with it. But I really like educating. I used to teach seminars with Bill, and that was the time of my life. And I love teaching. Is I believe in karma. I want to give back. And so with these podcasts, like with IBD Live, I can only talk for so long,
Yeah.
or I do the SMT with Ali on Fridays right after the
Yeah.
close. Those last an hour long, and everyone's already complaining it's too long, it's too long. But I've got a lot of things I want to say. I'm like, how could I do this? So I decided to just do a podcast on my own for as long
Yeah.
as they take, and some of them are 3 hours long. Most of them are about 2 hours long.
Yeah.
And there's two reasons. One, I wanted to give back to people, but two, I've had some health issues in life and didn't, like you realize life is short. And I
Mm.
wanted to have something to leave to my kids who are 23, my twins, is on, I never taught them how to trade. And I wanted, if they ever got into trading, to learn from their dad, as well
Yeah.
as, one day when they have kids, for their kids, my future grandkids, to have something to learn from. And I was like, I want to write a book, but I just don't have the time. So I'm like,
Yeah.
I'm going to do these videos, and it's on YouTube only right now. It's on my channel, Webby5150, and please watch them. They're free. I'm putting these things out that I could charge a bunch for, but I also talk. I talk and talk and talk. That's just me. That's why it's called Webby Rambles On, because I will babble, but I'll talk for 10 minutes. 30 seconds of it is gold. The rest of it is fluff, but it is what it is. And so I'm just trying to give back. I'm a big believer in karma. I can use some. So, I'm just trying to help out. And I put one out every Saturday, and
Okay.
tons of fun, man. So
Yeah. The
looking
show's
forward to
called
having you on.
Webby 5150. I love
Yeah.
the Van Halen reference.
Yeah.
Thanks for explaining all that to all of us. Mike, awesome to see you. Thanks so much for all that you've done and continue to do to educate investors. Thanks for making going on IBD Live a really enjoyable time. I'm already looking forward to the next time we're on there together. But for now, I'll say thanks so much for coming on the show, and we'll talk to you again soon. All right.
Thank you.
What a fun conversation with Mike Webster. I love Webby's quote that he shared there: "Be aware of your strengths and be aware of your weaknesses." Right? Such a great way of thinking about yourself as an investor. This is something we would do with portfolio managers at Fidelity all the time. Really start to think about what are your strengths, right? What's your edge? What do you do well? How can we, build a portfolio approach around your strengths and help you leverage those to find success? But also, what are your weaknesses, and having a very, honest and open conversation with yourself about what you don't do well. And then how can we surround you with resources and support and stuff to help you minimize the negative impact of your weaknesses. And I think approaching your investing growth, your growth as an investor with that lens can be very, very helpful. This was a great reminder that I need to pay much more attention to the IBD Composite score as he's describing what it is. I remember early days in my career, I discovered IBD. I would get the paper every morning from the newsstand in New York City. I would go to the Bloomberg office, and a friend and I would go through page by page and look at stocks that looked well according to their methodology and try to understand more about why that was and how we could replicate that approach in our own investing. The investor I am today is, driven in no small part by those many years of looking at IBD every single day and just trying to understand it better. Great conversation with Mike Webster. I hope you enjoyed it, and I'll look forward to going on his podcast called Webby 5150 here very soon. So check that out as well. That'll do it for today. By the way, if you want to learn more about some of the technical side of the tools that we talked about here, how you can analyze stock trends, find top performing names, and look for those with the opportunity to grow for months, if not years to come. Our Market Misbehavior Premium memberships may be a great opportunity for you to upgrade your own toolkit as an investor. 3 great benefits to the premium membership. First off, you will have access to our members-only community. This is where you can ask questions. This is where you can learn from other investors. This is where you can, go through this challenging year of 2025 with an awesome support group of chart-related investors helping you along the way and asking some great questions. This is where your questions will be answered every day as well. I'm in there every morning answering questions from my premium members. Second, you'll have access to all of our virtual courses like Flight School Behavioral Investing, where we teach you all about behavioral finance and technical analysis tools and techniques. Finally, you'll have access to our members-only reports. Our weekly flight plan is our main report. Comes out every weekend. We look back at the week that just happened, what was new, what was different. We look forward at the week to come. What levels, patterns, signals are we on the watch for? Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. For more information on that premium membership, go to marketmisbehavior.com/premium. And don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts.